management, I wanted to briefly extend my sincere thanks to the many folks who support QUAAF and that make this unique practitioner-based learning experience possible for our students in the various graduate business programs we offer at Queen's. Our supports and our supporters are many and formidable. First, thanks to the faculty and administration at Smith, who continue and provide continued oversight, guidance, governance, mentorship, including individual faculty members who constitute the QUAAF board of directors and set the framework of operational, financial, and risk policies and the investment strictures that govern the fund. Second, thanks to our benefactors who have made donations to Queen's that have served to seed our fund. We continue to welcome individual and corporate charitable donations to QUAAF to further augment our objectives and opportunities for growth in scale and diversification in our portfolios and operations. Next, I want to thank our advisory board and industry mentorship teams, including many QUAAF alumni, like Reese Barnett, who I believe is on the call, and the hedge fund managers in Canada and beyond who provide their time and expertise to augment the unique student experience and learnings. And finally, I want to thank all current and former QUAAF alumni who, after 9 years, and believe it or not, 18 cohorts of different management teams, have, through remarkable dedication, diligence, and work ethic, allowed to grow in a sustainable, well-governed manner, which permits the fund to be passed from one generation of grad students across 5 programs and 3 different geographic centers to the next generation of grad students. And in that regard, I want to give special thanks to the current outgoing QUAAF exec and management teams, drawn largely from the current graduating cohort in MFin, and passing the torch to our new incoming QUAAF executive management teams, drawn from Masters of Artificial Intelligence, or the MAI, our MBA, and our Masters of Management, or MMA, programs. I continue to have great confidence in the QUAAF program and its ability to achieve the unique learning, networking, and financial objectives the student experience is designed for. So now I'll hand it back to the QUAAF management team and or Sean, and let him take you through. So thanks a lot and enjoy the presentation.
Thanks very much for those words, Peter. So before we get into the year in review, I'm also very happy to invite 2 of our founding members, David Yao and Peter Szaflarski, to share a few thoughts with us as well.
Perfect. This is David here. Can you hear me?
Yes, sir.
Fantastic. Well, first off, thank you very much for including us in this meeting. I mean, it's an absolute pleasure to be here. Just want to note that it's remarkable to see how far QUAAF has come, and each and every one of you should be proud of all your hard work and all that you have accomplished. Looking back, it's been almost a decade now. Peter mentioned the 9th meeting. Since this fund was started, I mean, I still remember us day trading e-minis out in our team room and holding our first meetings over Pi and CQP. We launched this initiative really to promote, number 1, continuous education, and number 2, professional development. And it's certainly impressive to see how each subsequent year have worked tirelessly to further elevate and progress this, and to see the continued support of Peter, the entire Queen's team, and industry partners. I'll leave you with this. I mean, this is our lasting legacy. So it's on every QUAAF member, past and present, to ensure that your hard work and success this year continues into the future. With that, I'll hand it over to Peter S., our very first Chief Risk Officer of the fund.
Hello, everyone. I have a name up there that's like U6074135, which makes it very confusing to identify me. My name's Peter Szaflarski. At work, I generally go by Peter Jacob because it's easier to spell Jacob than Szaflarski. So just if you want to reach out to me, that's how you find me. I'm either Peter Jacob or Peter Szaflarski, spelled just like it sounds. Now, David and I synced up a couple days ago about what we're going to talk about. David was going to talk about the founding story, and I was going to talk about what's the value that QUAAF is now driving back to the community and back to the students. And after I hung up the phone, I realized, wait a minute, I'm going to be explaining the value that this is driving to people who have been driving this value for years since I've been gone. They know more about it than I do. So what the heck am I doing trying to explain it to them? So I tried to think of something that I could impart to you guys. So I'm going to try to take a little bit of a different spin on it. And in that vein, David on the same call managed to call me a contrarian. And it's true. I identify as a contrarian. I like to think that I think differently from everybody around me. And the funny thing about that is on this call, I now see 102 participants, and I guarantee that all 102 of them, you all see each other as contrarians in your own right. So I think we all have that in common. And I recognize the irony in saying that I'm a contrarian just like everyone else, but I think we all identify with that a little bit. And the value that you can get from something like QUAAF is that you get to look at alternative assets, and they are by definition contrarian in their own right. If they weren't contrarian, they would just be assets. So what you get to do as someone who's part of the Alternative Assets Fund is talk to people, reach out to people who do this for a living, who are actually contrarians, who build contrarian opinions for a living. So if there's something going out in the world like COVID-19, like a financial collapse, like whatever else, you'll hear what the mainstream media is telling you. You'll hear what is being said out there on various news outlets. And what you can do is form your own opinion based on that. And I'm sure it's a very educated opinion. Instead, what you can do now is reach out to people who form these opinions for a living and don't just run perpendicular to this, but run perpendicular in many different ways. And speaking as a contrarian, that is value that I think that I got when we were doing this, that I got to see that people don't just think the opposite of what's being said, but in completely different ways that I didn't think of. And they're forming these opinions in a really educated way. And that's exciting. So I think one of the things that we can get from this, the value that we can drive, is to contribute to that pool of contrarian ideas that are well thought out, that aren't necessarily aggressive, but can continue to build that value for this community and the community as a whole, like whether it's Canada or the world. And I think that that's the value that I wanted to impart to you. And I hope that that's a little bit of a different spin than what you were expecting. And just like David, I'm very impressed with what's going on here, and I'm really excited to see what's up next. So thanks for my floor time. I'll hand it off back to Alex.
Thanks very much, David and Peter, for those words, and we really do appreciate your continued involvement and engagement. So without further ado, I'm now pleased to pass the floor to our CEO, Sean D'Souza.
Thank you, Abby, and thank you, Peter, David, and Peter again for all the words you've said. We really appreciate it. And to give you an overview of what QUAAF is a student-run investment fund that invests in alternative strategies through hedge funds and internally through its thematic and global macro portfolio. We have been in existence since 2013, and this is our 7th year of existence. And our offices are located in Toronto, Kingston, and Beijing, the 3 campuses of Queen's University. On this slide, you see the 2 teams that manage the fund, both in the first and second half of fiscal 2019. And I would like to extend a huge thanks to both teams. Both teams made this year truly successful and took QUAAF to a level never seen before. And I want to thank, first of all, the team that led the first half of 2019, led by Chunxiao. Their leadership and guidance allowed us to have a strong foundation, and we hit the ground running in the second half. And to my team in the second half of 2019, we achieved far more than any of us could have imagined. And I'm proud to have worked with each and every one of you. And I want to say thank you. So a quick glance of our governance structure. At the very top is our board of directors, consisting of Peter Copestake, our chairman, Queen's University faculty, and industry professionals. They're the ones who set the overall direction of the fund. Our alumni and advisory board provides guidance on how we achieve that. And our executive team is the one responsible for achieving this. But I also want to point out that without the portfolio managers and the analysts, they're the ones who do the bulk of the work. They're the ones who actually helped us achieve what we achieved this year. And I want to say thank you to all of them. Some history about QUAAF. QUAAF was started by a group of MBA students. It soon incorporated Masters of Finance students as they were a natural fit given the nature of this fund. Its purpose is to give students a chance to apply what they learn in class and also give them a chance to go beyond what they learn in the classroom. Now, to give you an idea of what we've achieved this year, let's take a look. Now, 2019 was the first year we actually started recruiting management analytics and artificial intelligence students. Their expertise in programming and analytics gives a fresh new perspective to QUAAF and positions the fund in line with the tech movement in the industry. We also launched our global macro portfolio. This is an internally managed long-short fund that will be managed by our Beijing team, and it will be overseen by a multi-factor model. And you'll have a chance to hear about that model in a bit. And finally, we've expanded our talent pool to also include accelerated MBA professionals who bring a further diversity and professionalism to QUAAF. In sum, we now represent 6 master's programs at Queen's University. We've also moved to support gender equality. Our first team was mostly male. This is, of course, no longer the case. And more women have joined, even involving senior level positions. I would now like to hand over the floor to Stefanie Wu, our Chief Investment Officer. She has been instrumental in building a strong investment team that has provided detailed and thorough analyses, both of new and existing investments. And she'll give you an overview of our investments currently and our future direction as well. Go ahead, Stefanie.
Thank you, Sean, and good evening, everyone. My name is Stefanie Wu, current CIO of QUAAF. Now, before I start my presentation today, I would like to introduce and thank the portfolio management leadership team for the first half of 2019 fiscal year. CIO Martine, together with her investment team, have established solid ground for us. 2019 has been a busy year for all of us. We certainly hit the road running since our cohort took over QUAAF. Personally, I have had a great deal of help from my colleagues this year, and it is a great honor to work alongside such an amazing group of driven and dedicated people. Xingran, Ryan, Jay, and Li Hui have provided tremendous support in training new analysts and improving investment processes. The thematic growth team led by Zubair has contributed many outstanding investment ideas for the year. On the other side of the globe, under Sean's leadership, the global macro team has never been stronger. We have achieved a lot milestone this year. On the hiring front, we added many talent to the portfolio management team. And I want to take a moment to thank them for the great work they have contributed to QUAAF so far. Throughout 2019, together with the macro and risk team, our analysts have worked really hard to uncover new investment opportunities and conduct a deeper due diligence on existing holdings. For those who are not familiar with QUAAF's strategy, QUAAF combines both external and internal managed mandate to create a holistic investment program that's designed to provide positive performance over a full business cycle. Our internal mandates include thematic growth and global macro, while the external mandate consists of market neutral and growth portfolio. Now let's dive into the investment process and the portfolio. The investment process for both mandates are quite similar and has only improved since QUAAF founded. I wanted to highlight this year, we leveraged talents from the newly created data analytics team and expanded our capacity in quantitative research. Moving on to the strategic positioning of the fund. For much of 2019, financial markets accelerated on the heel of unprecedented fiscal and monetary stimulus at a time where no real growth in the underlying economy is shown. Now, staying true to our goal of capital preservation, QUAAF's exposure to market neutral portfolio has never been higher, sitting at around 65% at end of Q4 2019, reaching our strategic allocation target. At the same time, we kept a weighted average cash position of 15% throughout the year as we see the increased importance of liquidity. On the investment front, we have made 3 new investments: Dynamic Global, Linwood, and Nugent Equity Longshore Fund. We've also exited Vantage Fund in April 2019. Vantage has been a contributor to QUAAF. At the time of exit, our exposure has generated 20% holding period return since August 2016. Going forward, we remain disciplined and optimistic when it comes to putting cash to work and maintain liquidity in the portfolio, so that we'll have more opportunities to do so in 2020. Now moving into the performance. The fund is slightly up for the year 2019 and generated 1.47% return, outperforming both S&P TSX total return of negative 16.9% and HFRI fund-to-fund composite of negative 3.9%. More importantly, the fund was able to generate alpha at a much lower volatility. The first quarter of 2020 has pointed to a more volatile and uncertain market backdrop. However, QUAAF's Q1 2020 return of negative 79 basis points versus the broad market decline of more than 20% for the S&P TSX composite highlights the fund's ability to weather through tough environment. As the world changes and investment landscape gets more and more complicated, our tactics will evolve, but our goal will remain the same: capital preservation and maintaining the real purchasing power of the fund. Before I pass the floor to PMs who will go over some of the highlights related to their portfolios, I wanted to take time to thank our board of directors, alumni, and our predecessors who regularly deliver important insights regarding both investing and the business of running an alternative fund. Thank you all very much. And now I'll pass the floor to Ryan, market neutral PM, who'll go over one of our best performing funds for the year.
Thank you very much, Stephanie. Good evening. My name is Ryan Yin, and I'm one of the market neutral manager in investment team of QUAAF. With a 4.24% return in fiscal year 2019, HGC Arbitrage Fund is one of the best performers during the fiscal year. The fund is an arbitrage strategy that specializes in special purpose acquisition corporation, traditional merger and arbitrage, and subscription receipts. Let's look at their performance. They outperformed the S&P TSX total return composite in both short-term and long-term. They generate negative 1.45% year-to-date return when the market is down more than 20%, and a superior annualized 5-year return compared to the benchmark. HGC is one of the examples in our market neutral portfolio. We hold 8 funds in total with multiple strategies like equity long-short, event-driven, fixed income long-short, etc. Our goal is to find the fund like HGC that has low volatility, high liquidity, and ability to generate low quality return to the market, which make us different from a traditional fund. Especially in the current market condition, alternative fund shows its true value. A hedged portfolio can minimize the drawdown and create alpha. Before I hand off, I'd like to take the time to thank the executive team for their support and guidance throughout the year, and also all the analysts in market neutral portfolio. Thank you for doing all above and beyond research on our current holdings and finding new investments. Next, I'd like to invite Zubair to walk us through the highlights of the thematic growth team.
Thanks, Ryan. Hi, everyone. My name is Zubair, and I was the portfolio manager for thematic growth. There were many ideas our thematic team covered this fiscal year. First, we looked at the cold storage food market and observed that there's increased demand for products with a longer shelf life. The total addressable market for cold storage is at $98 billion right now and is expected to grow at about 12% per year. As a result, we have looked at temperature control warehouses that would preserve these perishable foods. With surging demand for e-commerce grocery deliveries, this would spark more construction of refrigerated facilities. Next, we looked at the esports industry and its rapid growth. The total addressable market is at $1 billion, and this is expected to double by 2022. Users spend more time on average per day on e-gaming than any social media outlet like Snapchat, Instagram, or even TikTok. From the chart here, you can see that the League of Legends World Championship tournament brought in more viewers than Game 7 of the NBA Finals, the Game 7 of the MLB World Series, and the Game 6 of the NHL Stanley Cup Finals. As revenues continue to grow, we're looking at buying maybe an ETF in esports or equities in companies such as Activision Blizzard, EA Sports, or NVIDIA. We also looked at the growth of 5G, the development and deployment of 5G wireless networks, which is supposed to be 100 times faster than 4G, will enable higher data services to be provided. As a result, we believe that tenants within the wireless space will continue to invest and deploy additional infrastructure and equipment across their existing networks. This increases the demand for communication towers and makes tenants willing to pay more for the leases as they are critical to their network infrastructure setup. Our last theme, we looked at companies that were well positioned to take advantage of hydro, solar, and wind in the renewable power generation space as we transition away from traditional fossil fuels for electricity generation, such as oil and coal. The thesis is quite simple. Electricity is a basic service and remains in demand even during lockdowns. Hydro provides baseload electricity, while wind and solar are paid based on the amount generated and not consumed. Lastly, I want to thank my team, Michael, Madhu, and Jaime, for their incredible work as analysts. Now I'll pass it off to Zingran, who will talk about the achievement and developments made this year.
Thank you, Zubair. Good evening. My name is Xinran, and I am the other market neutral manager in investment team. It's a great honor and pleasure for me to run you through the achievement of investment team this year. Underpinning our stellar performance this year is a tremendous improvement in our investment processes and teamwork. Our macro team expanded its research capability by leveraging quantitative models to assist both the portfolio management team and the Beijing team. The portfolio management team continues to drive the ongoing refinement and improvement of our investment process, as well as the documentation of such processes. We've improved analyst ownership that analysts are assigned with coverage of our current holdings. Moreover, we've made some brand new initiatives for learning opportunities. We rolled out training content in video format to improve knowledge transfer between terms and kicked off QUAAF Low Maintenance Book Club to share reading list, company annual letters, and other learning materials to learn from professional investors across the world. Our engagement with the hedge fund industry has never been stronger. We were invited to Donville Kent Asset Management annual presentation in January this year, and we then scheduled an office visit, spending an evening with Jason Donville and his team to learn about their views on the market and investment processes. Thank you, Jason, Jesse, Basil, Dominica, for your continued support. We also attended Quest Productivity Media Income Trust Investor Update Call, and thanks, Cindy, for inviting us. It is happy to learn that funds like Quest face more opportunities than challenges in the COVID-19 world. Here, I want to thank all of the fund managers who have been updating with us. These site visits and opportunities continue to play an essential role in our due diligence process. Looking forward, we will continue to drive analyst exposure to the industry and improve their understanding of alternative investments. Thank you very much. Now I would like to invite our CRO, Hasib, for risk team review.
Thank you, Shinran. Good evening, everyone. My name is Hasibur Rahman. I am Chief Risks Officer of QUAAF. Thank you for joining us today. It is my pleasure to present on behalf of Rick's team about our success stories in the last fiscal year. Before diving in, I would like to take a moment and introduce our team. Under Rick's team, we have two dedicated departments to support risk management process of QUAAF. Our due diligence team ensures compliance of existing and new investments according to our IPS and our platform development team is assigned to update fund fact sheet and generate monthly performance reports. Apart from our regular task, we have successfully completed a couple of projects in the last fiscal year with a view to enhancing our risk assessment tactics for our fund. Our risk management framework has 3 dimensions. At first, we conduct our due diligence on existing funds based on our investment policy statement and individual funds performance reports. In addition to, we also consider fund-specific due diligence questionnaire to obtain holistic view about its investment strategy, risk evaluation process, and other regulatory and governance factors. Then we apply different risk management tools to derive risk exposures and its impact on specific portfolios and overall fund. To understand the risk profile of a new investment, we assess its investment strategy, correlation with our existing holdings, and risk tolerance limit as per our IPS. As investment and risk team work side by side, we share our thoughts from risk perspective with investment team and help with the decision-making process. The last fiscal year was quite successful for us. We developed a new due diligence checklist to review the risk exposures of our investments in a much more efficient way. Our platform development team has done an incredible job to transform our risk analytics model to our platform. In addition to that, we also developed a fund master list to facilitate screening of potential investments in the hedge fund universe. Now we are working to automate some of our activities using cloud services. In the last fiscal year, our fund's risk profile was moderate. We were able to contain our fund's volatility compared to all major indices, both in short term and long term. And we are also navigating strategies to improve risk-adjusted return over time. Moreover, our goal is to achieve less correlated returns compared to market, although we were able to achieve that in the long term. However, we are actively monitoring our high correlation to market in the short term. In terms of return distribution, we are negatively skewed in the short term while the range of skewness improves over time. We are mostly in tachycardy level range, which is less than 3. It's desirable for our fund, but we are cautiously monitoring our kurtosis level pertaining to 1-year return. Finally, I would like to thank our advisory board for their guidance and our team's continuous effort in the endeavor of improving risk vigilance of our fund. Thank you everyone for your patience. Now I would like to hand over to our chief economist to talk about global economy. Thank you.
Hello, everyone. My name is Tom Wilson. I'm the chief economist on QUAAF, leading the macroeconomic team and the predictive analytics team. Please go to the next slide. Thank you. To provide you with context on what our teams do, the macros team main objective is to provide QUAAF with a top-down view of the current global macroeconomic environment that helps guide asset allocation and investment decisions. To help guide our macroeconomic views, we leverage the predictive analytics team's proprietary economic and time series model to provide us with an estimated outlook on any index or security. When determining our global outlook, our team looks at broad macroeconomic indicators like GDP growth rates, manufacturing and service PMIs, central bank policy rates, and initial jobless claims to help guide our macro team discussions and provide recommendations to QUAAF on the bi-weekly team meeting. Since taking over as chief economist in mid-January, our focus has been dominated by COVID-19 and its effects on the global economy. Next slide. What started as a domestic Chinese epidemic, COVID-19 quickly evolved due to slow and ineffective containment measures by the West into a global pandemic that has grinded the world's economy to a halt. China and other Asian countries like South Korea have been and continue to be successful in flattening the curve and containing the spread of the virus due to mass testing, infected patient tracking, and effective shutdown procedures. The US, now the epicenter of the pandemic, has over 840,000 confirmed cases with no signs of the virus abating. Initially, COVID-19 created a global supply side shock that disrupted supply chains across the world, with China shutting down its economy. However, this quickly turned into a global demand side shock as the virus spread to the West, who reluctantly started to adopt social distancing and work from home measures that kept consumers at home. If you could, next slide, please. Just when things couldn't seem to get any worse, on March 23rd, after a production cut agreement with Russia fell through, Saudi Arabia unleashed the taps and flooded the world's oil market with cheap supply in an already demand-shocked oil environment. The impact was felt immediately, with oil prices falling to their lowest point in over 2 decades. On Monday of this week, WTI crude oil futures for May delivery priced below $0 for the first time ever. The global oil market is truly entering uncharted territory. Next slide. This dual shock from COVID-19 and oil price collapse sent global asset classes into a complete free fall during the month of March. Even safe haven risk-off asset classes like US Treasuries were not immune from panicked investor selling. Small cap equities and real estate were some of the worst performing asset classes over the quarter. Next slide. However, as investors, it's important that we put the COVID-19 market sell-off into context. Although the severity of the market decline was unique in speed during this crisis, it was not in size, as we can see similar drawdowns during the financial crisis and tech bubble and the flash crash. Next slide, please. A second order effect of the COVID-related economic shutdown and the collapse in oil prices was the potential for a credit crisis in the US and across the globe. Liquidity started to dry up in money markets, muni markets, CP markets, and credit markets. Right here, you'll see the US general corporate debt index with the US high yield index. And you can see that during the crisis, we saw corporate debt spreads widening at a faster pace than in 2000, 2008, and 2015. Something needed to be done immediately before an arguably even bigger crisis was to occur. Next slide. With the scars of the great financial crisis still in mind, policymakers wasted no time and embarked what was the largest fiscal and monetary relief package the world has ever seen. Adopting a whatever it takes attitude, central bankers and governments from across the globe injected over $10 trillion, approximately 11.7% of global GDP, of combined monetary and fiscal stimulus. The US, moving at an unprecedented speed through the Fed's 13.3 emergency facility programs and the fiscal stimulus delivered through the CARES Act, subsidized incomes for laid-off workers, provided direct financing to small and large businesses, and embarked on the largest QE asset purchase program in history to ensure that there was liquidity in the financial system. Next slide. Although the global economy has received unprecedented support from its governments and central banks, we're still not out of the woods yet. Clearly, the longer it takes to reopen economies across the globe, the more of an impact it will have on businesses, specifically manufacturing and services. Purchasing Managers' Indexes, or economic indicators, derived from monthly surveys of private sector companies that summarize whether market conditions are expanding, staying the same, or contracting. A PMI above 50 represents an expansion, a PMI reading under 50 represents a contraction, and a reading at 50 indicates no change. The top chart, this shows the absolute level of manufacturing PMIs of Canada, China, Japan, UK, US, and the Euro area, while the bottom chart shows the standardized movement. As was expected, manufacturing PMIs declined sharply over the month of March due to COVID-19's far-reaching economic impact. Next slide. If manufacturing PMIs declined sharply in March, then service PMIs fell off a cliff. Service industries have been hit the hardest during the COVID-19 lockdown, especially in the US and UK, where service PMIs deeply contracted over the month of March. Next slide, please. Questions, so it's really coming down about recovery. So questions about whether the economic recovery will be a V, U, or L, or W-shaped are, in our opinion, misplaced. The economy has literally fallen off a cliff and is plunging to an unknown and unprecedented depth. It will bottom and rebound, beginning on the day that we start to reopen the economy. The initial bounce will be sharp and very much V-shaped, but there's no way we will see the overall level of GDP return to its pre-crisis level for quite some time. We believe the economic recovery hinges on the following 3 factors: policy intervention, economic conditions, and virus risk. Starting with policy intervention, this has been extremely successful, and policymakers have assured the markets that they will step in with further support if needed. Rising risk asset prices are unlikely to cause policymakers to rein in easing. Moral hazard concerns about rewarding excessive risk-taking are much less important than in previous recessions. The original shock is a virus, not irresponsible leverage and asset price overshoots like the late 90s tech bubble or 2000s housing bubble. Economic conditions will continue to deteriorate as the virus-related economy shutdown persists, as I mentioned. But interestingly enough, equity market sentiment has become bullish over the past several weeks. Consider how we've been receiving freakishly bad economic data, including last week's initial jobless claim of 5.2 million, bringing total losses to greater than 22 million, which is roughly 12% unemployment rate in the US. And yet the S&P 500 ended flat on that day. Financial markets are seeming to communicate a narrative that seems completely out of sync with what we know lays ahead. The US and the global economy are facing a massive contraction, and the way forward is very uncertain. Finally, virus risk, and this is without a doubt the most important. Until the US and other virus-stricken countries can flatten the curve and significantly reduce the number of new cases, the US economy and global economies will take longer to recover. A viable vaccine that's widely available for distribution would be the most ideal option, but this is not expected to be available until 2021. Also, amplifying the risk of the virus is announcements like the Trump administration encouraging states to prematurely reopen their economies, which increases the likelihood of a second outbreak occurring before the first outbreak is even contained. Finally, I just want to touch again, thank on my team, the macro team. They've been great helping me and the rest of the members on QUAAF. And speaking of QUAAF, I think QUAAF is extremely fortunate to have such a diverse pool of master's students to recruit from. Every member on QUAAF brings their own unique skill sets and offers a different perspective on the markets and investing. Our next speaker is a perfect example of this. It's my pleasure now to introduce Sam Lee, Director of Analytics on the macroeconomic team, who will be providing you with a brief overview of the time series forecasting model and the multi-factor model that he has developed for the macroeconomic team in QUAAF. Thank you very much for your time. Sam, take it away.
Thanks, Tom. Hello, everyone. My name is Samuel Lee, and I'm the Director of Advanced Analytics team. Here at our team, our goal is to develop tools that provide quantitative outputs that can benefit our portfolio team's investment decision-making process. Currently, our team is engaged in 2 projects. Our first project is a time series forecasting model, which forecasts the long-term return of an underlying security or index based on historical time series data. This project is currently at its last stage where we're preparing for release for use by portfolio teams. The second project is the one that I would like to focus on. At our team, we have developed a multi-factor model which forecasts monthly return of an index based on an algorithm that uses multiple economic factors that are backed by statistical correlation with the market. Currently, we are utilizing factors such as industrial production index, consumer price index, unemployment, price of oil, and money supply. The table you see in the middle is an excerpt from the model that shows its current forecast accuracy. We can see that the forecasted February S&P 500 return is not that far off from the actual return we saw in the market. The multi-factor model provides benefits to our portfolio teams in many ways. Firstly, the calculated market forecast can be used to either support or call down our current market expectation. Secondly, by comparing the empirical return with the actual return, we can identify whether the market is potentially overbought or oversold. Thirdly, the model can test and identify which economic factors are effectively correlated with the market. The multi-factor model is an algorithm that is constantly being updated. Our goal is to optimize the model so that it maximizes forecast accuracy even in turbulent times like now. With the creation of QUAAF's first advanced analytics team, we have embarked on many exciting projects with more to come. The 2 projects presented today marks our first milestone and shows our capability to build more functional and robust analytics tools in the future. Furthermore, our team has opened up more opportunities for students from technical programs to join QUAAF as well, such as from MMA and MMAI. Thank you, and now I will hand it over to our operations team.
Good evening. My name is Alex Banh, and I am this year's Director of Business Development for QUAAF. And we'll be running you through the operations team's accomplishments this year, our future initiatives, and I have some asks for the audience at the end as well. Before I begin with the meat of the content, I just want to say how proud I am to have worked alongside such a dedicated group of individuals this past year. From Edom Harrison, our COO's unwavering ability to manage projects, to Aslan's perpetual good humor, to the MMA trio of Abby, Neha, and Luis, who are some of the hardest working and driven people I know. We're also thankful for the guidance from Rabia and Trevor, months after they've graduated, despite having just started new jobs at Scotiabank as a manager of strategy and as an economist at Omer's Capital Markets. As Sean mentioned, this is the first year. We've mentioned this many times now. We've had MMA, MMAI, and AMBA students on the team. I'm actually very excited to have every program represented on my team this year. I've also taken the liberty of showing the diversity of industries, functions, and jobs that our team has achieved in the recruiting processes, which is testament really to the broad set of skills that are required to keep operations running smoothly. Now, our alumni network is a force to be reckoned with. This year, one of our major initiatives was to reignite the connections between alumni all the way from Peter and David's year of MBA 2012s to the recently graduated MBA 2020s. The way we went about this was a partnership between the business development and marketing teams to conduct what we call alumni spotlight interviews, where we ask questions about their career progression, their QUAAF experience, and their advice. And in doing so, also caught them up on what's been going on in QUAAF these past years since they've graduated. These lessons learned were then condensed into transcripts published on LinkedIn for the rest of QUAAF and the broader Queen's community. The results were really unexpected and really staggering. Alumni from all years and both MPhil and MBA programs came out of the woodwork and responded instantly. And even those who didn't want to be featured and weren't comfortable with being on a public forum enthusiastically referred us to their friends and their colleagues. On this page of logos, we have every single graduating year of alumni on this page. So obviously our social media and other marketing channels skyrocketed in reach, but that's just really scratching the surface. This month, our thematic investments team pitched Boralex, an independent power producer, which we didn't really have much experience analyzing. So we jumped on a call with Bert Chen at Valuating, which is a subsidiary of Brookfield Renewable. Bert is a member of the MBA class of 2018 and the former chief economist of QUAAF, who turned out to be very familiar with his competitor and answered all of our thematic team's due diligence questions. This is just one example of how we're realizing brand new synergies between operations and biz dev. The last thing I want to say on this is an issuance of open meeting invites. Any alumni are welcome to come to or dial into our weekly meetings Thursday nights at 6:30 p.m. We're very fortunate to be sharing in the years of wisdom and experience of our alumni, and we thank you. Moving on to two other pillars of the ops team this year, advancements and events. It's no secret that Queen, Smith, and QUAAF are engines for career development and advancement, placing students in some of the most coveted jobs in various industries. This year, we've taken that one step further, creating the QUAAF resume book that will be posted on our website. We've also formed a partnership with Thorick Scott & Partners, an executive search and recruiting firm with over 40 years of experience in placing professionals in the financial services industry. Our speaker series event in November brought together 3 heavy hitters representing 3 of the major exchanges in Toronto. And we expect to continue hosting similarly high quality events for the QUAAF community down the line. Now I want to tell you all about some of our upcoming planned initiatives. With this new normal of remote work, we're going to be starting a QUAAF Slack workspace to coordinate workflows in the 2020 to 2021 team, using various technologies within the platform to bring our Kingston, Toronto, and Beijing teams closer together, not only as a fund, but as a community. We'll also be replicating that sense of community with an alumni channel, bringing together all 9 years of alumni to facilitate both old and new connections. To enable that, I want to make a small ask of all of you here today. We want a class rep from each of the MBA and MPhil classes since our co-founders graduating year to unite and corral your own classes and bring them into the fold. In doing so, we'd also like to launch the inaugural QUAAF mentorship program, where any student on QUAAF who stays on for more than 1 term gets a dedicated alumni mentor in their 2nd term. If you're interested in helping out, please reach out to any of us on the 2020 executive team. Lastly, we want to take every opportunity here to facilitate as many networking opportunities as possible. In lieu of us being able to talk in person with Sean forcibly muting all of you, if you're interested in connecting with any of the current students or any of the other attendees, we'll reach out after this event with a survey. Those who sign up will be paired up regularly over the next quarter with multiple people who are also in attendance. I'd like to close off by saying that the operations team looks forward to all that is in store for the 2020 year and remain passionately dedicated as your stewards of learning and development, event hosting, and relationship building. I'd like to invite Sean back up.
Thank you, Alex. I hope that you all like what you saw today. And I want to thank my executive team for making everything that happened this year actually happen. This meeting also represents a changing of guard, per se. With the MPhils now graduating at the end of this month, we actually have to elect a new, or at least choose a new executive team. And without further ado then, I would like to introduce our new CEO, and that is Alex Banh. Alex has been chosen because of his exemplary work ethic, his experience, and his willingness to go above and beyond his call of duty. I'm excited for what he's going to do, and I'm looking forward to the next year and the years after that, because I know we've built such a strong foundation. At this point, I'd like to finish at this point, and I'd like to open the floor for questions. I know a few questions have come in through the chat. Please also use our email. You can use that to ask questions as well.
Thanks very much, Sean. I'd like to reiterate our thanks on behalf of the incoming QUAAF executive team to our 2019 and 2020 executives for another successful year, and thanks to their vigilance, dedication, and sheer commitment in leading us through it. We wish them all the very best as they continue forward into post-graduation life, and we look forward to working with them in their alumni capacities. Thank you to all of our guests for attending, and without further ado, I will now begin going through the questions as sent in. So the first question for Sean: how has COVID impacted operations?
It has been quite challenging. What was initially, what we all thought, at least what I personally thought, was going to be maybe a week, 2-week disruption at most, and it's now turned into a 2-month disruption. That being said, we have leveraged online technology such as Zoom, such as this meeting, extensively to make this happen. And I would say that even though it has certainly slowed things down, we've still achieved a lot of our goals, and in some cases, we've actually gone above that. So I would say that it's a minor blip in otherwise great year.
Awesome, thank you, Sean. Next up, for Stefanie, what is the portfolio composition?
Hey, thanks, Abby. If you can flip to the slide 17, please.
Slide.
Yeah, so as of Q1 2020, market neutral portfolio is the biggest exposure of the fund, representing 65%, and growth portfolio is sitting at 27%. We haven't made any investments so far to the thematic portfolio, and we have cash sitting at 8%. 2% out of the 8% we hold in US dollars. So we're pretty happy about and feeling comfortable with the exposure that we currently have in the portfolio.
Thank you, Steph. One more question for you. What's the reason for the underperformance versus HFRI FOFSI?
So we're actually outperformed for the year, but if you look at the longer term numbers, yeah, we underperformed to the general hedge fund composite. So I wanted to say that first of all, our goal of the fund is to rather than outperformance, our goal of the fund is capital preservation. And if you look at our missions, QUAAF is looking for positive performance over a full business cycle. So we're curious to see how the future holds. And second of all, throughout 2019 and as much of the previous years, liquidity is always a very important component for QUAAF, and we have never been fully invested in the portfolio. I think this creates probably the biggest drag to the fund-of-fund composite performance. Hope that answers the question.
Thanks very much, Steph. So our next question is for Zubair. And of all the themes being pitched, what's your best idea and how will you approach it when when you decide to invest?
Thanks, Avi. So we discussed four of our ideas. I think our thematic slides in slide 20. I think one of the more fascinating ones that I like is currently esports. It's truly it's growing at a rapid pace. It's currently compounding at an annual growth rate of about 12%, and there is just like a lot of revenue generation that's going on from sponsorship to media rights to publisher fees. So in terms of a strategy, we looked at certain ETFs in the space, like the VanEck Expo ETF or the Nerd ETF. And we like that because you're kind of well diversified within different gaming publishers within the industry. So if there is kind of like a hot game or hot new game that's like the next trendy game, you can kind of invest within that across different companies. So you don't have that risk of being right on one company. So I really like that in terms of user engagement. Obviously, there's more people that spend on average time on esports platforms like Twitch or in China, Huawei, than like social media platforms like Instagram or Facebook or TikTok even. So it's really fascinating how that sector is growing, and would love to get involved with that in the future.
Thanks very much, Zubair. And actually, a follow-up to that question, what's driving revenue in the esports industry?
Yeah, so in terms of the total addressable market of that 1 billion, I think a lot of it is coming from sponsorship. So let's say the League of Legends, like there's like a League of Legends championship series. So there's like a lot of sponsors within that will sponsor the teams that are like really good at that particular game. So like in North America for the League of Legends tournament, there was like 5 Hour Energy, Monster Energy, Twitch, who were the sponsors. Over in Europe, for those kind of tournaments, you had, I think, like Adidas, Mountain Dew, people like that, companies like that. And in terms of just media rights, there's also revenue coming in from like certain media just wanting to stream a particular tournament. So if there's different leagues, like Facebook will have exclusive rights to like Pro League and esports. ESPN is involved in the League of Legends World Championship, Twitch, YouTube. So those are definitely two of the main drivers, sponsorship and media rights.
Awesome. Thank you very much, Zubair. Our next couple questions are for Shinran. So how did the opportunity to visit Donville Kent and Quest come up?
Okay, thank you for the question. So because we had a new pitch last year, so I was the analyst at the time, and I really liked the fund, the DCAM, so I contacted the fund managers if they could provide more information to us. And then they said they would like to present in our QUAAF weekly meeting and share their ideas of the fund and their strategies. So we then have the following annual presentation, and we have the following office visit.
Awesome. Thank you very much, Shinran. The next question is for Alex. What is the benefit of moving to Slack, and how does that compare to our existing infrastructure?
So as you can probably tell right now from this presentation, QUAAF is a lot of teams and then teams within teams. And this broader team is separated across 3 different cities. So the kind of Slack workflow is actually very, very useful for combining these teams so that they actually work in a cross-functional way together. Right now, we're on both Microsoft Teams and on WhatsApp. WhatsApp, we have something like 30 different threads going on. It actually runs quite efficiently, but Slack is just that much better. And we're trying to make it so that Kingston and Toronto are constantly communicating. Yeah.
Perfect. Thank you very much, Alex. And we have one more question that was in the chat. And here it is. What's the QUAAF team's thoughts on how the global central bank policy, especially the Fed and Bank of Canada, affecting markets, and specifically, how does the massive decline in the rates affect the portfolio's allocation to fixed income and currency?
Well, from the massive decline in rates, obviously fueled by central bank QE purchases, and really having the key policy rates going down to 0 level. If you were long duration at the beginning of this would have benefited any kind of any fixed income security. And right now, what this is doing is it does support risk assets with a Fed keeping rates at such low levels. It's really just trying to encourage, potentially provide a bottom to credit markets and to risk assets like equities as well. But in terms of the overall effect on the market neutral portfolio, Steph, do you want to maybe take that one?
Yeah, sure. Thanks, Tom, for adding your thoughts to this. As we mentioned in my presentation, that we really see all the unprecedented stimulus happening in the economy, where company earnings, there's really no real growth. If you look at all EPS beats, it's all coming from corporate buybacks. And earlier this year, we've seen the inverted yield curve, and everyone has been sort of very nervous about the market, about high valuations and everything. That's why we decided we wanted to overweight the market neutral portfolio, where hedge fund managers can do long short, specialize in long short. So that's kind of what our thesis is, and we decided to max out our target allocation for the market neutral portfolio. Hope that answers the question.
Awesome. Thank you very much, Tom and Stefanie. And we had one more question come in for Zubair. Could you expand a little bit on the difference between ESPO, Hero, and the Nerd ETFs?
Yeah, sure. So sorry, Abby, can you just go back to the schematic slide again?
My pleasure.
So in terms of the ETFs, I think so on our strategies, we put the ETFs that we like. So the ESPO ETF is a lot of investment in the composition and concentration in game publishers. And it doesn't really get away from that. So those ones are more like the composition's more in the States. The Hero ETF is one listed on the TSX, and it has a very similar composition. I think there's just a little bit of more of a composition in Japan. So Japan's the highest weighted country, and so they have investments in Nintendo and stuff like that. The Nerd ETF is a little bit different. I think it's way more of a pure play in esports. And I say that because the ESPO ETF, the first one that we listed, that one is more so game publishers, and it has companies in there like NVIDIA, who do graphic processing units for these games for the development. But then NVIDIA does so much more. So there's exposure to other risks that are not just like esports related. Whereas with the Nerd ETF, you see them investing in also like the streaming market. So in China, for example, Twitch, which is the platform where you watch a lot of the games, you're not able to stream that in China through Twitch. So there's a live streaming platform called QUAAF. So they've invested in that. A lot of the streaming market. There's also companies like not your traditional Activision Blizzard, EA Sports. They've also looked across the globe into a company called DreamHack, which is like a Swedish production company specializing in esports tournament and other gaming conventions. So that's how they're a little bit different. I would say, in summary, ESPO is more like gaming publishers and more like large caps, well-known names, whereas the Nerd ETF does a little bit of that and more pure play into like the streaming market within esports. Thanks.
Perfect. Thank you so much, Zubair. At this point now, I'm happy to open up the floor to anyone in the audience. If they have any other questions that weren't already addressed, please feel free to unmute yourself and ask your question.
Hi, this is Sekhar from MMAI. So last time when you opened up the team for the expansion, somehow I couldn't get into the onboard. And if I'm interested to be part of your team for the 2021, what is the process?
Hey, this is Alex. We're going to be kicking off a new round of hiring for QUAAF, both in May and June, to coordinate with the start of the new MMAs coming in. and the new MFin class. So you should look out for applications coming out then.
Okay, yeah. Thanks, Alex.
But you're welcome to attend Thursday meetings anytime.
Perfect. Thank you very much, Saker. And then I think I saw Ben raised their hand.
Yes. Hi, can you hear me?
Yes.
Okay, great. Great presentations, everyone. Just a quick question for the analytics team. There were two papers out back to back in 2018 and 2019 by JP Morgan that statistical modeling using traditional machine learning algorithms are not able to predict market behavior as accurately because market behavior is truly random. And the consensus was towards more self-supervised algorithms, such as reinforcement learning. I'm just wondering if you guys maybe taking that into consideration. If you're doing the statistical modeling, how are you evaluating the model's output?
Hi, so I'll answer that question. So for evaluating our output, we always backtest with the actual return data that we see in the market afterwards to see the accuracy of our prediction. In terms of the machine learning strategies, I agree that I always say this disclaimer to our portfolio teams. These analytics tools are serves to provide a kind of a range of that we can predict the market to behave in the future. The accuracy of the prediction is not always accurate 100% of the time because, like you said, the market depends on multiple factors that we can quantify. But there are a lot of new ideas in the markets. That, for example, I know MSCI is working on machine learning to find out potential market forecast based on like Twitter feeds and news articles by filtering through the keywords in the article. So there are a lot other methods that are rising, and we will explore those alternatives as well to improve our models.
What is your accuracy?
So our accuracy right now is we have 10% error for the multi-factor model. And for the time series forecasting model, we can alter the accuracy depending on, so for the time series model, that one we can adjust because the time series model gives an output which is a range of potential future prices. And we can shorten that range depending on the percentage of confidence interval we set for the forecast.
All right, thank you.
Thanks very much, Sam and Ben, for the question. Are there any other further questions from the audience? There is a raise hand functionality that can actually be accessed from the Zoom chat box as or sorry, the participants window, my mistake. All right, if there's no further questions, I'd like to...
Actually, James raised his hand.
Oh, perfect. Thank you, Peter. James.
Oh, thanks. Yeah, sorry, I didn't know I could unmute myself. So I've been coming to these for quite a few years, and this is the best yet. Like, you guys have really knocked out of the park here. Yeah, kudos to your whole team and the folks running it, overseeing it. So I had a question on COVID-19. Like, we've been kind of working under the assumption at CASA that it's going to be 12 to 18 months of a lot of home isolation before there's a vaccine and that. So what have you guys assumed on the COVID side, and how might that or has that or would it at all affect your models going forward and where you're investing?
In terms of the duration of the the crisis. I know we've been looking at China as a benchmark, but when you're starting to see China, again, what I was mentioning in this kind of my brief is that they've been very effective at the containment. They got it on it early, but really until we can see the U.S. start seeing some positive signs, it's very difficult to kind of gauge. I would hopefully we would say maybe like the next 12 to 18 months we could start seeing some recovery. But I think as we see cases continually rise again in the U.S., it's extremely difficult to kind of put down a specific kind of a timeline for that. I think it's very difficult, and I know that's not a great answer, but it's really kind of like an unknown at this point. I think with the second wave risks that is already happening in Japan and Singapore, like the second outbreaks, like it's really difficult. And then of course, if, as I mentioned, the end of the states, I think Georgia was one of the first states that have officially reopened. If they reopen prematurely and there's a second outbreak, like I have no idea on how long the impact will be. Like ideally, I would say within the next, again, to your kind of estimated range, the 12 to 18 months would be. But I have no idea. And it's one of these things that, we're trying to monitor closely, but it's very difficult for us to kind of put down a specific timeline on that. I think China is again, they've been very successful in containing the virus. And you're seeing manufacturing get back to work. You saw their manufacturing and service PMIs have a significant uptick back, actually above contraction area into above 50 in their last reading. So there's signs of improvement, but the long-term implications of this, like it's tough to really put down. So I know that's not a very good answer, but it's very difficult at this moment to really kind of put down an actual an estimate on that.
Cool. Hey, James. Also, I'll add one more thing. Like our thematic team was also looking at kind of more defensive sectors, like during a time like COVID. So our analyst, Jaime, he was looking at renewable power. And what we realized in renewable power generation is that like electricity is a basic service and remains in demand even during lockdowns. So industries like companies like Boralex or Brookfield Renewable, because they have exposure in hydro, solar, and wind, like hydro provides baseload electricity, which is the minimum electricity required, while wind and solar are based on like the amount generated and not consumed. So that's something that we think might be potentially COVID-proof. We also talked about esports briefly, where a lot of people are under lockdown. So they might be at home or just at home. So there's really nothing like that might even increase from a demand perspective on just like the streaming end. So those are two spaces that we have looked at on our team. Yeah. Thanks for your feedback.
And I can add a little bit to the hedge fund holding side, since COVID is a big topic and sort of on everyone's mind. So once the COVID hit, we actually take a proactive approach and reach out to a lot of fund managers and trying to get their feedback and making sure their portfolio is right positioned. We're really glad that some of our holdings like Quest and HEC, they are in sort of different strategy. It's not impacted by the equity market meltdown. And other holdings like JM Catalytic holds a lot of cash since beginning of the year. And also funds like Lightwater, they do a lot of shorts. So some of them actually benefited from the market drawdown. So that's, we are on top of it. So I would say all the funds, current holdings in our inside QUAAF are, we're comfortable with the risk that we're taking.
So
that's great. Thanks, guys.
I have a quick question, just to tag on to this theme of COVID and esports. I like the play of that in a COVID environment, esports should perform well versus traditional sports. I think that makes a lot of sense. But has there been any discussion about the fact that in esports, a lot of the high viewership, high revenue generating events, whether it's, you know, League of Legends or whatever is played, are actually live. They're usually broadcasted live in stadiums and then simultaneously casted, you know, around the world where people watch them. So despite the fact that, you know, people are staying home and watching on Twitch, the major events that are still sponsored, I would imagine, would still have a drop in viewership. And I know I sound like I'm telling you guys, but I'm not the expert. I'm actually asking you guys if this is something that we know about or we're looking into it.
Yeah, James. Yeah, that's a good point. A lot of this, a lot of the live events that happen in actual stadiums, like especially I know it's pretty big in China and then in the U.S. as well. Those are being postponed just like regular sports. But our view is that there's a lot of things offsetting that kind of risk. So when you're like investing into an ETF, there are just like many companies within that have different exposure in terms of publishing games. So from a demand perspective, like you're still going to see a lot of people that couldn't attend those live events still go over on Twitch or QUAAF because they lost that opportunity. And you know, there's still a sponsorship interest for those successful teams because there's like people have nowhere else to go. So even though that's a risk and it's kind of like been postponed like regular sports, whereas regular sports has been completely shut down, where there's just like nothing coming out of the NBA or the MLB season has completely shut down and they just not figuring out how to make money. Our call is here is that there's a lot of places where they can make money. And so there's less risk from that perspective. But definitely that's a good point on the live sporting events where you get a lot of these e-gamers around the world in one place. I get your point on that for sure.
And there's a level of irony to esports being defended by a guy with a Kobe Bryant picture there.
I was trying to change that, but yeah, long as Kobe. Yeah, I miss sports too, and you know, in our broader discussion, when I was actually researching this, I was really surprised and even offended, rather, that some of these live events are garnering more of an audience than the NBA Finals Game 7, or so. It is fascinating, to be quite honest with you. I'm just being objective and looking at like the numbers. Like I don't get it either, but there's clearly a trend here. So we're looking at that for sure.
Thanks.
Awesome. Thank you very much, Peter, for your question, and Zubair for your answer as well. Are there any further questions? I don't see any raised hands in the participant window.
Well, I'd like to thank everybody for coming out and participating tonight. I want to congratulate again the outgoing team and welcome the incoming team. It gives me great joy to be working with you guys and to see the development of this great fund. So thank you, everybody. Call the meeting to a close.
Thank you very much, Peter.
Thanks, everyone.
Cheers, everyone. Enjoy the rest of your weeks and have a good weekend.
Be safe.